What's going on, world? It's your boy Jordan, aka Stack in Silence, and I am back. The Shades is back for episode 2 of Free Game. What are options and how to make money in options? That's everybody's question. This video is sponsored by the Beard Guard. As you see, I got my beard guard on right now. It keeps your beard protected from any food, cold weather, and it keeps it moisturized. They got the beard butter, they got the beard oil, they got the beard spray, they got what else you need. They got body butter. Let me show you what else they got. Check the website out. All their products is right here. It's called thebeardguard.com. Support black businesses. The Beard Guard link will be below. Let's get to these options. Okay, everybody wants to know what are options, what is options trading. I'm going to explain it to you. Basically, options is a contract giving the buyer, you, the right to buy a call or a put of an underlying asset at a specific price or an expiration date. Let me say that one more time. It is a contract giving you, the buyer, the right to buy a call or a put of an underlying asset at a specific price or an expiration date. What does that mean? It's giving you the right to buy, for instance, Apple at a specific price or at a specific expiration date. Which brings us to our next question. What are call options and what are put options? The easiest way to explain it is, you, the buyer, when you buy a call option, you are saying that the underlying asset price will go up and I'm gonna make money. Now, when you are buying a put, you're basically saying the asset price, the underlying asset price will go down and I'm gonna make money from it going down. That's basically it. Calls, you make money from the price going up. Puts, you make money for the price going down. Easy peasy, lemon squeezy. Now, contract. As far as contract, each contract has 100 shares. Again, every contract has 100 shares that you, the buyer, can buy for a premium price. Once again, a contract is 100 shares that you, the buyer, can buy at a premium price. I'm going to show you what I'm talking about. So for this option example, we're going to use my favorite, Macy's. You already know how I feel about Macy's, and right now they are about $27 a share, $27 a share. Now, like I said, we have calls, we have puts, we have a strike price, and we have our expiration date, correct? We all can agree, one contract equals 100 shares. All right? We can also agree that if you wanted to buy 100 shares of Macy's right now, you would pay $2,700, right? Why? 100 times $27 is $2,700. Cool. The benefit and the great thing about options, you're not going to pay $2,700. You will pay a premium price. It all depends on what your strike price is. Basically, what you think Macy's, the underlying asset price, is going to be. And also, you need your expiration date. You're saying that Macy's will reach a specific price by a specific date. So let's say you woke up and you heard Macy's has some big earnings or some big news, right? And you feel that this $27 of Macy's is going to go up to $30. All right? Let's just use that as an example. And you want to buy a call option. So let's just write this down. Remember what we said, 100 shares of Macy's will be $2,700. Remember that? Cool. You want to buy a call option with a strike price of $30. And you feel that Macy's will hit $30 by expiration date March 4th. Okay? Let's say that's how you feel. Macy's gonna hit $30 or more by March 1st, right? Instead of you paying $2,700 for every 100 shares, the premium to buy this call option is, and this is right now, 0.07, which reads $7. So as of today, well, you can't get it today because it's Sunday, but based on today's price, if you wanted to buy one call option with the strike price of $30 and you feel is going to hit $30 or more by March 4th, you would pay $7 for 100 shares of Macy's. Now, you're probably wondering, you probably made a mistake. That didn't say $7, it said 7 cents. Yes, it said 7 cents, but that's not how option prices are read. If it reads 0.07, which is technically 7 cents, it means it costs $7, all right? If it said 0.70, which is 70 cents, it costs $70. If it says $7, it costs $700, so on, so forth. That price that you see is the price per share of the 100 shares. That's why it says 0.07, all right? So 7 cents times 100 shares is $7. That's exactly how option prices are read. Now, say you woke up, right? And you heard some bad news. Bad news about Macy's. Something happened, who knows, right? And you feel like, okay, this $27 is gonna drop. I feel that it's gonna drop down to $24 by March 4th. We're gonna use the same expiration date, all right? So basically you feel that you feel that this $27 will drop to $25, all right? You, the buyer, want to buy a put option, right? With a strike price of $24. And you feel that this $24 will be met by March 4th. Okay? Because you feel like the price is going to drop, which you're saying, I'm going to make money by this dropping $3. All right? Well, it says on the price on Robinhood says that this put option price for March 4th is 0.20. If it reads this, it means it costs $20. If you want a put option with a strike price of $24 and you feel that it's gonna reach there or lower by March 4th, you will be paying $20 for every put contract, which is 100 shares. Now, the glorious thing about options is you never, ever lose more than what you put in. You never lose more than what you invested in. But you will make as much as you had those many shares. What do I mean by that? If you buy an option contract, right, of those 100 shares, you do not own those shares. Those shares are lent to you. Now, if you buy 100 shares of Macy's, which is $27, you will own those shares because you bought common shares. See the difference? So now I've explained what an option is, how many shares one contract has, calls, puts, strike price, your expiration date, how to read premium prices, right? Now we are going to talk about the Greeks, the great old Greeks. What are the Greeks? You have the delta, you have the gamma, the theta, the vega, and the rho. Now when I'm explaining this, we're still gonna use Macy's, $27 per share, all right? And we're gonna use the strike price of $30. Let's stick with that because that's what we use. The delta basically is the total amount price is expected to move based on a $1 change of the underlying asset. It measures the $1 change of the Macy's $27 price. Goes up $1, goes down $1, all right? The delta is read like this, 0 point, and it has four places. Basically, how much money you will make per share for every time Macy's move $1 up or $1 down. So if the delta is, for instance, 0.50, and your option price for the $30 strike is 0.07, remember the 7 cents, but it's $7. That means when Macy's go up $1, the price of that option will move up 50 cents, which will turn it to 0.57, and it will be $57 instead of $7. Now, while explaining this, we're still going to continue using Macy's as the example, all right? So we said Macy's was $27 a share, correct? Let's continue using the whole option numbers that we used before. It was the strike price that we was using was $30, okay? The expiration date we said was March 4th. All right. And we also said the price for that call option was 0.07, which was $7. Okay. We're going to continue using that. The way the delta is, the way you will see delta written on the option is this. I'm just using this as an example. May not, it may be different numbers. I'm just using this for the example. Okay? Now, if it's a put option, it will say here you go. So basically, a delta is the total amount price expected to move based on a $1 change of the underlying asset price. So the underlying asset is Macy's. Every time Macy's moves up $1 or down $1, okay, this price will move this amount. And it'll be this if it's a call. All right. If it's a put, it will say this. So if it's going up, it will go up 4 cents. If it's going down, it will go down 4 cents. Understand? So if Macy's goes up to $28, for example, right? This will move to which means it's now worth $11. All because this went up $1. Okay? So if you bought this option at $7, this goes up to $28. That means your option price moved up, quote unquote, 4 cents, $4, and you're in profit. Now say the price is going against you and Macy's it dropped down to $26, all right? Hold on, let me switch this. Let's say Macy's dropped to $26. $26. That means this right here falls to and now you are down $4. We don't like that. We definitely don't like that. When you're looking at the delta of an option, it will read 0.0400 or 0.0475. For the purpose of this video and keep it simple, I just use 0.04. But if you do see that, what I do, I just round it. For instance, if it says 0.047, I just say 0.05. That's just me. Personally, that's how I look at it. Now, the next thing we're gonna talk about is the gamma. All right, so as far as the gamma, right? Let's make some room real quick. We're still gonna leave, I'll rewrite that. Still gonna leave the option price. Still gonna leave this. I'm just making some room because we're gonna need some room, all right? So we had March 4th, and we also had price of the option was 0.07, which was $7, okay? Our delta, red 0.0, I'm just gonna put the other digits, okay? And then our gamma, let's just say, for video's sake, the gamma red 500, okay? The gamma measures the rate of change in the delta when the underlying asset moves $1. Okay, let me say that one more time. It measures the rate of change in the delta when the underlying asset moves $1. What the hell does that mean? I'm gonna tell you. Let's just say Macy's moved up to $28. Okay? What the gamma reads is when Macy's go up $1, which is 28, this will add on to this, which will add on to this. Okay? So when you do that, when this adds on to this, it makes it 0.0900, okay? Which then makes this what price? 0.16 cents, which is $16. You made $9 on that one option so far. If this moves $1. Again, it also all depends on different variables, the volatility, the stock, news, etc., etc. So I'm just making this as basic as possible. Now, the next Greek we're going to talk about is the most important Greek of them all. It is called theta. What is theta? Me, I personally call it the ticking time bomb. Theta is basically the effect time has on your option price. Again, I'm gonna say it again. It's the effect that time has on your option price, we're gonna use Macy's as example once again. We said Macy's is $27. We said that we got a call option with a strike price of $30, and we saying that it's going to reach $30 by March 4th. What does the Theta do? Since March 4th is literally around the corner and we have $3 until hit $30, okay? The Theta number will be high because it's so close, all right? Which is basically saying, I don't know if it's gonna hit $30. So let me start deteriorating your option value. Since I don't feel that Macy's is gonna hit $30 by Friday, let me start wiping away or chiseling away the value of your option price. Yes, sucks, I know. People hit me up all the time in my DMs like, oh, I bought AMC option, a $17 call, and it was $14, now it went up to $16. Oh, why am I losing money? When did you get the when is your expiration? Oh, my expiration is tomorrow, and it's at 16? Yes. Well, basically, Theta is saying it don't feel like it's gonna get to $17 by tomorrow, so let me start chipping away at your price value. That's basically what Theta is. Simply put, this is why personally, when I buy options, I make sure the expiration date is about a month to 2 months out. Why? Because that means Theta numbers are smaller. Your option value has time to grow because news can happen at any time, okay? So you have time, you can sit on it, wait, you never know what can happen. But when you buy, say, a weekly option where you're buying an option now and you're saying next week it's gonna, expire or it's gonna reach the strike price by next week, it's a little bit more riskier. You have a higher Theta. So be careful, smart to always get options that have an expiration date far out if you're not too familiar how to trade them. So Macy's again, as an example, our call was 0.07. Say Theta says 0.01. Using that as an example. As the time get closer, say there's 2 days or a day left before your expiration date. At a certain time, it could be every hour, it doesn't matter, throughout the day, your price of your option will drop 1 cent, 1 cent. It'll keep dropping 1 cent, all right? Now, say if the option price is 75 cents, which is $75, okay? And the Theta is 0.05. The closer you get to your expiration date, your option price will start deteriorating by 5 cents, slowly but surely. So basically $5 will start coming off slowly but surely. Hey, if the price shoots up, then your Theta numbers get smaller and you will start getting that back. So Macy's again, as an example, our call was 0.07. Say Theta says 0.01. Using that as an example. As the time get closer, say there's 2 days or a day left before your expiration date. At a certain time, it could be every hour, it doesn't matter, throughout the day, your price of your option will drop 1 cent, 1 cent. It'll keep dropping 1 cent, all right? Now, say if the option price is 75 cents, which is $75, okay? And the Theta is 0.05. The closer you get to your expiration date, your option price will start deteriorating by 5 cents, slowly but surely. So basically $5 will start coming off slowly but surely. Hey, if the price shoots up, then your Theta numbers get smaller and you will start getting that back. So that's basically what it is. Now the last two are the VEGA and the RO. Not a lot of people pay attention to it. Honestly, I don't, but it's good for you to know just because it's part of the options, okay? So VEGA basically measures the sensitivity of the volatility of an option price. Let me say that one more time. Basically, it measures how sensitive the volatility gets of an option price when you hear some type of news or something. For instance, you have your Macy's call for 7 cents, aka $7, right? How sensitive does the price change happen based on news Macy's get? All right, so that $7 option can stay $7 all day, 2 days, 3 days, because it's not really volatile. Your VEGA numbers will be low. Now, say the option price has a lot of volatility. Okay, it moves to 7, moves to 10, 10 feet, like it just moves different prices all day, high price range all day. The VEGA numbers will be high. So that's all it does. It measures the sensitivity of the volatility of the option price. Now for the row represents the rate of change between an option's value and a 1% change in the interest rate inside the option price. Again, it represents the rate of change between the option's value and the 1% change in the interest rate of the option. If you want to know how the interest rate is determined, go on Google or Investopedia and it'll explain everything for you regarding that. I'm not going to do in this video. It would take too long, all right? But what I am going to do is give you an example, all right? We're going to use Macy's once again. We're going to change it to green because you already know. Green is for the money and yeah, you know the rest, all right? And what have we been using? Option price 7 cents, which is $7. Okay? Let's say the row reads 0.05. Okay? Best way to explain this is if the interest rate in this goes up 1%, it will gain 5 cents to its value, which will make it $12 contracts. Okay? I'm making that as simply put as possible. That's the only thing it is. So now that I explained all 5 Greeks to you, the delta, the gamma, the theta, VEGA, and the rho, the difference between selling options and selling shares is this. When you're selling shares, you're selling it back into the market, okay? So you can just hit sell and go. When you're selling calls or puts, you're not selling it back into the market. You're selling it, you're hoping that someone else buys it, all right? If I'm selling my call to someone else, Bob has to be interested in my call, in my call contract to want to purchase it, and then it will sell. There will be times you'll be trying to sell your call or your put because it has hit your strike price and it will sit there. Why? Because somebody is not interested in buying it at that price yet. Okay? You can always adjust it to make it lower. If you want to turn that $7 option into 6, you can put 0.06, and what will happen? It probably will sell easier because you dropped the price. Which brings us to the golden question that everybody wants to know. How to make money from your calls or your puts. And I'm going to show you. We're going to use Dutch Bros as an example, all right? Cool. Now, Dutch Bros earnings is this week. I've heard it's a great company, been hearing about them since last year. Honestly, I haven't did too much research on them, but I will since the earnings is this week, and we're going to check out its charts, all right? So, based on the chart right now, I can see that it's on a small downtrend on the daily, correct? All right. But we do have a support line here at the 41.33 area. In my opinion, I feel price is going to hit here. And then when earnings hit, they may have great earnings. I feel it's going to go up. Retest the MA, and then we might just see $58 or $59. This is just my opinion based on what I've heard about this company and how good they've been for the past year and a half, okay? So I feel that a nice option play may be having a strike price of $50 by, let's give it 2-3 weeks, okay, if it goes up. Now, if the earnings is bad and they have a bad report, and I feel like we may need to get some puts, I think it will break this. If it breaks this line, okay, then most likely is going to retest down here, or just, yeah, it may retest down here and then go up. I would look into some $40 puts. I'm just using this as an example based on the direction of the market. If it goes up, I may get some $50 strike price calls. If it goes down, I may get a $40 put or $40 strike price on my puts. Now we're at the option chain for Dutch Bros, okay? As you see here, we have an expiration. We're at the expiration date of March 18th, all right? There's no other ones. So we're gonna do is March 18th. Like I said, based off the chart, I feel like they're gonna have a great earnings, great guidance. I think they're gonna retest the $58 mark. The smart move I would do, this is just me, okay? I will look at my strike price. I'll think about getting $50 calls. Why? Because we're at $47 and 50 is right there. And if I feel that $58, $59 will be the mark off of good earnings, I want to get in the lowest strike price that I can, depending on how much buying power I have, and also depending on all the Greeks and everything we spoke about, all right? Let's say looking at the strike price, looking at the break even, all right? So what I would do is it costs $2.90. Remember? Oh, it don't. This reads $290. So I would spend $290 for every call contract of Dutch Bros. All right, let's click here. As we look here, you see the volume is low. Open interest is okay. The applied volatility, this is basically saying it's 100% that it may just hit $50 by March 18th. Okay, it goes the delta, the gamma, the theta, the vega, and the rho. Remember when we talked about that? Every time Dutch Bros moves up or down $1, it loses or gains 42 or 43 cents on this option price. Okay? That's basically it. So like I said, what I would do, and what I might just do, I would look into these $50 strike calls, right? $2.90, and I will buy it for March 18th. And also March 18th is a good time. It says, God forbid, Dutch Bros does have a bad earnings report and they do drop. You never know what can happen from the earnings to the 18th that may shoot the price up. So if it has a bad earnings and you see the stock dropping, just hold your horses a little bit. Just wait. You know what I'm saying? Don't get wrapped up in all to the selling. Just wait, hold it down, POP, and just let time go and see how if your option still if your option appreciates, or will it become worthless? You have to make the call based on the numbers that you see. Now, like I said earlier, if I wanted to look into some puts, if I feel like their earnings is going to be bad, they're going to drop off bad news or something is going to happen, right? If we look at March 18 puts, and what did I say? I feel like it may fill in that lower support line. Didn't I say that? Cool. So if they do have bad earnings, I said I wanted to look into some $45 puts. All right? You know what? Yeah, let's do some $45 puts. Why would I look into $45 puts? As you can see, it's green. Why? Because the Dutch Bros price is dropping right now. The market is open. Market goes up and down, up and down, up and down. So if I wanted to buy a put with the strike price of $45, right? Okay, I will pay $340 per contract. All right, the volume is really low. open interest is not that bad. It's actually high, all right? Here goes your Greeks. Why is there negative on the delta? Because if the delta on calls, it would be positive. The delta on puts are negative. Why? Calls up, puts down. So the delta is 37, gamma, theta, vega, and rho, all right? So based off that, that's how you would choose your puts. Now, I hope everybody got a better understanding of how options are done and how to make some money off of option. Yes, we are coming to the end of free game. What are options and how to make money in options, all right? Like I said, I hope everybody has a better understanding. If you don't, you can always hit me up in my DMs, my inbox, anyway, Instagram. I'm always available to talk to, and I'm here to help you the best way that I can. Remember, we have the strike price, we have the expiration date, we have the price of the contract, the Greeks, delta, theta, gamma, vega, and the rho. We explained all of that. Please, please, please be smart about investing. Use risk management and don't blow all your money off of a contract and then becomes worthless. Now you're broke. Okay? So thank you for staying in tune with me. It's your boy Jordan, aka Stack in Silence. This is Free Game episode 2. What are options? And I'm out. Peace.